Buybacks and insider selling have picked up in 2021, and we have seen massive gains in just about everything. Companies see more stimulus ahead, meaning more cash flowing their way. With interest rates at rock bottom, now is their chance to take reckless moves, massively leverage every aspect of their business, and grow to the point where potential systemic losses would consider them too big to fail, effectively granting them a guarantee for bailout. Funny how it works, isn't it? You came here for the truth, so let me unveil that for you. Today we're going to look at what's been happening with the money velocity. We're going to talk about the cash infusions. We're going to look at what's going on in the financial system. I'm going to show you various factors related to the money supply, how we are seeing actual changes that have occurred recently as a result of all the actions that they've been taking. I'm going to talk about some of the industrial commodities, show you what's happening to the price surges there. I've got a lot of factors to talk about after that. There's so much here. Let's go. Out of Bloomberg, buybacks snap back amid feverish selling by corporate insiders. Insider buying dries up after equity rally swells valuations. Of course, during this period of time, maybe they would decide that, all right, now's the time I'm going to sell some of those shares, not going to be buying as much. They do talk about this in here, something that I covered at the time. Back in March of 2020, insiders started to buy up because they saw this huge collapse in the price. So they started to buy in. I covered that here on the channel, made a note of it. And now you can see today that things have changed. So they have watched the market go up in basically a straight line. And many of them have decided to sell. Now, they're not selling all their shares. They're not emptying everything. You're not seeing Jeff Bezos suddenly sell off all of his shares because they've risen so dramatically. No, but we're looking at the insiders, the directors in the company and the VPs and all of this that are basically just getting rid of some of them. They're cutting some off the top. They're doing some shaving, they're not necessarily getting rid of the whole deal. All right. Surging stock repurchases reflect a focus on balance sheets. All of the companies are doing this. All the big companies love to buy back their own stocks because they can send the price up higher. This is the way it works. And usually what occurs, if we see it all the time, that there are these periods in which the market elevates to a certain point simply because of a stock buyback. And then that's when they execute their sale, the insiders. And then it goes sideways for a bit or maybe upwards for a bit. And then again, they do a stock buyback. The stock predictably goes up and they sell. And they can say anything they want to. These are planned in advance. But they know already that there are going to be buybacks. So they're taking advantage of the process regardless. Now, these individuals here, I don't know if they know all the insides, but they're insiders. I mean, these are high-level individuals. It's not the janitor working and he overhears something. Oh, I heard a great tip today. Or, somebody cleaning the room and he happens to see a pile of papers and found a ticker symbol and now he's going to bet it all. No, this is not what that is. These are people with complete and entire insights as to what's happening in the company, but they're not going to know every detail and every little thing that they necessarily are doing doesn't mean it's reflecting exactly what's going on with that company and you're going to see some major moves as a result of it. No, there's so much more going on there. After gutting buybacks to conserve cash, American corporations are repurchasing shares again. Corporate officers, on the other hand, are showing a bit less enthusiasm for their employers' shares. In the first 2 weeks of the year, a total of 1,000 insiders sold their own stock and 128 bought shares, leaving the sell to buy ratio poised for the highest monthly reading data going back to 1988. Meanwhile, corporations announced $29 billion of buybacks over the stretch. That's up 46% from a year earlier. So big news here, there's no doubt. Mixed message. Insider selling defies a recovery in corporate buybacks. You could see right now the ratio of insider sells to buy, it has picked up significantly at this point. And then you look at the S&P buyback index versus the S&P 500, and that has come up quite a bit, as you can note in this case here. It's just showing you what's been going on over the period. I'm not going to, put too much weight on something like this because you never know what's happening on the inside of any company, but it is worth noting, and then we can remember that in the coming weeks. Jim Paulson, who's consistently bullish, had some interesting things to say. I wanted to bring it to you. Even though the longtime bull acknowledges massive aid has been necessary to steer the US during this crisis, he worried that too much spending will spark sharp inflation. In a recent note, Paulson called it the most significant risk beyond this year. Here's the quote here. What latent unintended consequences is going to lead to? It could lead to more rapid inflation, which would necessitate more rapid tightening. And right here he says it could lead to a loss in world confidence and U.S. government finances. If it's the overuse and abuse of economic policies around the globe for that matter, but specifically in the United States. Of course, he says, I would stay bullish this year, stay invested, but you may want to think about increasing risks from latent policy prescriptions as we move forward towards the end of the year. Of course, stay bullish, stay bullish. He thinks that the S&P will be at 4,100. I mean, why not 5,000? It's kind of silly at this point. Why not 6,000? And I'm putting my prediction at 1 million, but you guys can deal with whatever you want. I think S&P at 1 million. Why not? You can just put any price there. And if you don't hit it, you just keep raising the bar. Why not? Nobody is really even considering any of these predictions at all anymore. It doesn't matter. If you're wrong in the prediction, nobody in the industry says anything. If you're right, nobody says anything. It's just a matter of how much money the Federal Reserve can print. And that's just about it. Jim Bianco put this, and I think I have two charts here. Stuff you can drop on your toe found on a factory floor is looking like a tech stock. So take a look at this. There's two charts on this page. High grade copper prices. It's going back from basically, let's say 2010, I guess that would be. And you could see that copper declining through this period. It's up, it's down, but 2020, it just started to skyrocket. And on the right-hand side, US Midwest domestic hot rolled coil steel prices have gone straight up, completely and entirely straight up. This is unbelievable to look at these different industrial metals, looking at different agricultural commodities, and it's starting to ring a bell from 2008. We saw this with many different things. Commodities went crazy throughout this period, and let's see if that continues. A chart that says a lot about today's market. Goldman Sachs non-profitable technology index. I mean, I had to laugh at this. Take a look. So let me read what it says first. The GS non-profitable tech basket consists of non-profitable US listed companies in innovative industries. Tech is defined quite broadly to include new economy companies across the GICS industry groupings. The basket is optimized for liquidity with no name initially weighted greater than 4.65%. Okay, so you get this basket. It's non-profitable technology index. It's including a bunch of things that are not necessarily just, let's say, Apple stock, but it's giving you a wide sense of what's happening. But the point is, they're not profitable. Now, you could say, oh, well, tech stocks, this is the way they grow. They're not profitable the first little while, and then blah, blah, blah. Okay, look at what happened here. In 2020, up until the present, it's gone straight up at this point after this period where we had the March correction, okay, during that time frame. But look at it in the years prior. You could say, well, this is technology, this is the way it works. What was happening in 2019? What was happening in 2018 and 2016 and 2013, all the way back here? Technology was just as important throughout this period. And, there's not these huge leaps and bounds between these time frames. So you can't use that excuse. This is speculation. This is nothing but complete and entire speculation through this period. And it is going off the charts today. Steel prices reach levels not seen since 2008. New capacity won't affect the market until late 2021. So current pricing levels may be here for a while. Just giving you some other insight on that. Real Investment Advice has an interesting article about what's happening with inflation, specifically their title, The Fed's Inconvenient Truth, Inflation is MIA. If you want to take a look, there's a lot of charts, there's a lot of quotes, there's a whole bunch of information that would be useful to you. I'm just going to highlight a couple points in here. There's a quote in here that says, the amount of money in the US economy is 25% higher than it was at the start of 2020, eclipsing any pace of money growth seen since the Federal Reserve was established in 1913. You know they are going off the charts. You know they are going crazy right now. It doesn't necessarily mean that we will see direct inflation in prices. It doesn't necessarily work that way, and they explain it in here, because if you take that money, print it, and bury it in the ground, it's not necessarily going to create price inflation. Now, the definition, the actual true definition of inflation, is the expansion of the money supply. But as we see it as an individual, the expansion of the prices, now that doesn't necessarily correlate. But if it makes its way into the economy, if it's loaned out into the economy, if it's buying and monetizing debt, okay, now we've got a different story because it's actually being utilized. Anyway, they do discuss that here. I don't have time to get into it all. All they say here is that the author is 100% factual and that it should be a cause for deep concern. Historically, such surges in the money supply were often met with significant inflation, and that's the threat. That's what we got to worry about. Okay, now check out what they said here. Looking at this, the surge in the money supply is indirectly funding the government. This is where you start to have a problem. All right, here, check this out. If the government spent all the money it borrowed and the recipients of the money spent it, velocity and GDP growth would be much higher. As a result, prices would likely be higher. The problem is not only frugal consumers, but believe it or not, the US Treasury, the graph below shows the Treasury cash balance held at the Fed is over $1.5 trillion more than average. The Treasury essentially funded over $1 trillion, backed by a higher money supply, which has yet to spend. Now, this just tells you that there is something brewing big time. There's going to be a major output that I think is going to have to be used at some point. And this is when we could achieve a much higher rate of inflation that they will admit. Now, you can look at the classic indicators, the CPI, the core PCE. I would have to venture a guess that these would never really tick up that high. There's the way that they manipulate them. But you know what? When you take into account the average, the basket of goods that people are spending, whether it's their energy, whether it's their food and so on, I think that we could be in for a world of hurt. Last point I want to make for this article, herein lies an inconvenient truth for the Fed. They are boosting the money supply and it's having an equally negative effect on velocity. As such, it's hard to forecast much inflation given current Fed policies. To quote John Hussman, once short-term interest rates drop to zero, further expansions in monetary base simply induce a proportional collapse in velocity. So I don't know what exactly the Federal Reserve is going to do, but the options here are that they start to spend money like it's going out of style. And that absolutely could be the next stage of what this criminal entity decides to do. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting the channel. So if you could just click that button, it would help me out. Thank you very much. If you want to learn about e-commerce, I'm talking about selling online, you can do so at the AmazonGPS.com. And if you want to know about the financial system, you want to understand central banks, how the money supply works, and so on, you can get that information in my 2 books. It's located at the link in the description. And if you prefer the audiobook, that's available at themoneygps.com. Hold on, wait a second, don't go anywhere. If you have not seen this video, you definitely want to catch it. Click it, I'll see you there.